From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, February 18th. You're listening to the Macrocast. This is Tony Fratto with Hamilton Place Strategies. We've got John Fagan, Brendan Walsh from Markets Policy Partners, as always, and then the great John Dick with Civic Science with us. John, great to have you here. We had the economic sentiment index that's been giving us a look at where consumers are. I think it's like we're in that inflection point. We're in an inflection point right now where, Omicron is going away. The numbers are diving way down, and governments are taking away, a lot of the mandates on masks and gatherings and other things. What's ESI showing us?
Yeah, it's an interesting trend at the moment. So the most recent reading that we just put out on Tuesday or Wednesday, it's the second lowest the ESI's been in 10 years. The lowest being sometime in mid-October of last year. So for 3-4 months ago, but really basically since just before Halloween, it's kind of been like a beer can bouncing around the bottom of a garbage dumpster. It's been low. It's a little up, a little down, a little up, a little down. We saw a tiny sort of like bit of Christmas cheer boost economic confidence through the holidays. And then it's been sliding really since the 3 of the 4 readings we've done since New Year's have been down. And there's a couple interesting things about that. One is, since COVID started, the economic sentiment index has pretty well tracked the pace of new cases and COVID spread. And maybe it's actually lagged it just a little bit because people feel like, oh my God, we're going to be in this forever. I frankly was expecting to see an uptick this time because Omicron cases were declining so fast. Yep. So I have to admit, I was a bit surprised to see it fall. It didn't fall a full point or anything, but I would continue to be optimistic that over the next 2 weeks we see it climb again. But it also, maybe it won't, and maybe some of these inflationary headwinds that consumers are feeling at the grocery store are overwhelming their optimism about Omicron for right now.
People are salty.
Yeah.
They are the numbers have been low. People are in a sour mood. Even if they feel good about like their own personal situation, they're pretty sour on, everything, it seems like, right? This is the era of bad feelings right now.
Yeah. Well, and you can talk, I know we'll talk later about Ukraine, but by and large, like the average consumer is not paying as much attention to that as we are. And so that's not the kind of thing that drags on them, but you're right. Mm-hmm. There's just an overall sense of negativity around, even something as simple as we study reaction to the Super Bowl commercials.
Yeah.
And like across so maybe every year some are good or some are bad, but the average consumer's perception of every Super Bowl commercial this year was net significantly more negative than it has been in the past. We're just like crabby about everything. We can't even
about everything. It's amazing.
People aren't even happy about the Olympics, right? It's like that's another thing to complain about. And so, yeah, there's just a pretty sour mood across the country right now. And, it had been for the longest time really sort of boosted and dropped by the COVID spread. And this is not happening right now. Maybe we can blame it on economic headwinds, but it just seems to be across the board negativity at the moment.
By the way, we talk about the economic sentiment index as though everyone knows what it is, and everyone should know what it is because it's a pretty cool tool that we created about 10 years ago now, between a joint project between Hamilton Place Strategies and Civic Science. And if you're out there in the world and you've heard of the Michigan survey or the Conference Board survey, it's similar but better and faster, and we think it's better, right, John? It's pretty good.
It's undoubtedly better.
10 years of data on it now that are people can see how it's how it's performed, how it's the window it's giving us on the economy. I think it's been pretty good.
It's undoubtedly better. I mean,
Yeah.
and of course we're biased, but I mean, it's empirically true. I mean, it is, sometimes I want to pull my hair out because it doesn't have the longevity such that it gets, as much attention, say, as some of the others, but it inevitably leads them. Like we are putting stuff out that a week later, all of the others say. And it's always, we write about a good bit about it, Tony. And so it's like, I can always point back to it and say to everyone, see, we told you this was going to happen. And one of those things, one of the reasons why is it's always on, it's real time. It's not like these other surveys go out at particular points in time, say 3 to 5 day periods, and grab some data and take a snapshot like on some arbitrary set of days in a given month and then project that for the whole month. Ours is always on. We're tracking 3-day rolling averages. It's just better science, better math. And so it's not that there's beyond that a whole lot of secret sauce. Although the other thing that we can do really well is because of the depth of profile information that we ask respondents, is we're able to cut it a lot of different ways to see not just, the US consumer population is not a monolith, and attitudes of some groups go up and others go down. And these other metrics aren't built to really capture that. And, so we're able to kind of find some of the signal that project or predict things in the market that the others just can't.
It's the elite sentiment index. It's not for,
we should call that's what we should rename it.
It's elite. It's
It has been fun though. I mean, we're right at a decade of history on the thing, and like everything else, COVID has just been like this incredible social experiment. But one of the more fascinating things that happened, like starting about a year and a half ago, is we track five different metrics primarily that build into the job market, housing market, personal finance, view of the economy, and major purchases.
Yeah.
And pretty much for the entirety of 8.5 years, those five lines kind of moved in a similar shape, month over month, day over day, right? Like generally, one might be a little bit higher than the other, but for the most part, they tended to be like, pretty much in concert. And what started happening in COVID that was really unprecedented was that we saw some of these lines depart from others. Views of the job market in the US got significantly better because lots of people were hiring, while optimism for the overall economy went down. We also now have a situation where a lot of consumers are reporting a pretty strong personal financial situation because of the money they've accrued over the last year and a half. But still, we have a really negative view of things like major purchases and the housing market. So it's interesting to watch those lines that always went in sort of concert with each other start to go in opposite directions.
Yeah. John and Brendan, the markets have been pretty salty this week too, huh?
Yeah, it's been kind of the parade of horribles that we've been talking about over the last few weeks. Honestly, it's the Russia-Ukraine crisis that has really been a huge headwind to sentiment, alongside continued Fed and global central bank aggressive rhetoric on withdrawal of accommodation, and this is of course wrapped up in the inflation picture. We got more hot inflation data this week, and ultimately the inflation in the markets. I know in the media, it's really a one note. It's inflation risk, inflation risk, inflation risk. If you look at markets, there's a contending growth concern that's showing up in the flattening of the yield curve, underperformance of growth sensitive sectors and components of the equity market, and just a sense that the Fed this is a really challenging thing for the Fed to do. How are they going to stick the landing when you basically have to tighten policy into what could very easily be a geostrategic catastrophe and a supply shock and a fiscal contraction and all of the above? So it's kind of a witch's brew. And this, of course, hit equities and credit markets when they were riding at like record highs, very fat and happy kind of valuations. And so it's almost like it would be weird if markets weren't down this year, right? This is earnings season. Let's face it, was okay, but you had some really big high profile misses. And so it's it's not a pretty picture. And I think honestly, you can almost the parts of the overall sort of message from the markets is pretty downbeat. But when you look under the hood, some of the most bubbly stuff is down like a ton. So there's still stability. The positive thing is this hasn't spilled over into systemic risk, and so if you're watching this from the policymaker's seat, you're saying financial markets are taking a punch, but they're taking it, right? They're not flat on the canvas with the mouthpiece next to them.
Hey, can I ask you guys to tell me the story of what is the knock-on effect of a Russia, Ukraine, Europe, US, if it becomes hot, right? So and I say this, and first of all, I hope we slap down the most significant sanctions ever done to a country not called North Korea. If Russia should invade Ukraine, I want them to go do the things they should do. But what's the story on this? Because at the end of the day, Russia is, it's an economy. I haven't looked at the numbers recently. I don't know. Is it bigger than the state of Illinois? I don't know if it is.
I think it was maybe Denmark and Finland. If you combine those,
it's it's an inconsequential economy from a size standpoint. Of course, it occupies very large space in things like energy and wheat commodities. Like wheat. In fact, Ukraine, Russia and Ukraine account for something like 40% of the world's wheat production. Right. So there's those kinds of those kinds of things. But what's the story? Though they invade, sanctions hit. What is the real hit to the global economy if this would happens? Are markets overstating it?
I think that the part of it is the uncertainty. Obviously, a massive war on the European continent is something we haven't seen in the kind of scale that a lot of strategists are expecting in a very long time. And so there is that unknown. The most obvious vector, I think, that people look at is the energy complex and the willingness and ability of Russia and President Putin to use gas and its energy, oil and so forth, plus commodities as as leverage. To squeeze those off. We saw that happen earlier this winter. It was, certainly part and parcel of the European and global inflation story. Energy makes a big component of that. We haven't really seen the Fed, differentiating between sort of inflation in a monolithic sense and something that is driven by geostrategic and supply disruption potential like this. And so this is, it feeds through to this. To that inflation and Fed tightening and global central bank tightening narrative, the idea that energy is a weapon. And we obviously see, WTI, U.S. benchmark WTI and West Texas Intermediate, global benchmark Brent. These are up at their highest level since 2014. I mean, these are lofty, in gasoline prices. I want to circle back to John Dick and see how finely they slice it. But certainly, pressure at the pump is a big issue for people, I would imagine.
Well, for sure. I mean, actually, gas prices at least had sort of stabilized there for a while. So that was one of the few bright marks coming through December into January. So again, the few average consumers pay enough attention to sort of global unrest like this to sort of have it affect their daily lives or daily views of things. And even the other thing, when you were talking about the markets earlier, that I've been watching that's kind of fascinating to me is just how entirely disaffected the average consumer is even by the stock market undulations, right? Like we all pay so close attention to it, but the average person really doesn't. We needed, all through COVID, it was sort of a constant that the stock market just continued pretty much to just go up, right? So we needed the variable event to see if it was like were consumers feeling better about themselves because the stock market was doing great. Well, the stock market undulating doesn't seem to have changed the trajectory of anything else that we track. The consumer just doesn't pay attention to it in the short term. Now, when it affects them in the longer term, if their retirement accounts get depleted, and I think it's the same thing here with, that they'll confront their concerns and fears over a war in the Ukraine if it shows up at the gas pump, right? And they may or may not like intellectualize the correlation between those two things, but until it actually hits their debit card, they seem to be pretty disaffected by all of it.
Yeah, and that stagflationary risk that you mentioned, John, I think is really that key aspect. And inflation, if inflation's hot because demand is so strong and the labor market's booming and that sort of thing, that's one thing. But if you have a situation in which oil has a huge geopolitical risk premium, people are paying more at the pump not because they're out driving and having a good time, but because of something that's happening halfway around the world. It's a totally different story. We saw when sanctions were slapped on Deripaxa during the Trump administration, it reverberated in the aluminum market. And because I know that the oligarchs have sort of changed the ownership structure so that they're sanctioning them personally doesn't necessarily hit their businesses in the same way. But the idea that a major producer of energy and commodities might be basically toe to toe against the West is a pretty disturbing thing these days. And also it's the Russians. What are they capable of in terms of messing with our infrastructure? These are the kinds of things that kind of sit in the back of the minds of investors who are really focused on this stuff. And what is Russian malware capable of if we really drop the gloves here and things go ballistic, as you said, Tony, in Ukraine? How bad can this get? And then will China link arms with Russia and create a world shaking kind of aggressive posture? These are the kinds of things that keep investors up at night and are some of the things that drive these undulations when we get the headlines out of Ukraine.
Hey, I want to let's take a break. I want to come back and talk about the point that you raised earlier, John, which is that through all of this, the Fed has a pretty tricky job ahead of it. Let's come back on the Macrocast and jump in and see what the Fed's going to do.
Every 2 weeks, HPS measures U.S. adults' feelings and expectations for the economy. The Civic Science Economic Sentiment Index, powered by HPS, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us through HamiltonPlaceStrategies.com.
All right, back on the Macrocast. John Fagan, you mentioned earlier, the Fed's got a really tricky job here trying to thread the needle in this environment where you have the potential for shocks. But the job was hard enough even without the potential for some of these shocks, just trying to get back to something like normal and dealing with inflation. How are they going to do it?
Yeah, it's a really challenging pivot that they have undertaken, and we've seen the Fed change its posture really quickly, and certainly when it comes to airtime, the loudest megaphone, it's the hawks on the committee, and so when this week in particular, we've gotten some. So Brendan, you've been following some of the chatter from the Fed talking heads here. What are some of the things that they've been firing off?
We talked about it a little bit last week when Bullard got it all going, but he's keeping it going. That the Fed's kind of behind the curve and they need to tighten rapidly. And Mester from Kansas City kind of reiterated Bullard's point later in the day yesterday. Today we get some from some more dovish people speaking, especially Williams. So we'll see how much they try to push back. I certainly think that Bullard isn't speaking for the core of the FOMC. The fact that Williams is speaking, he might be the one that you can take that's coming from the more from
FOMC. Yeah, but look, I mean, I thought Mester was pretty strong yesterday, and but we should be clear. Like, I mean, hawks and doves right now. Doves are saying, still elevate the rate. And
right.
Right, like
everything has shifted. So everyone's in agreement that we need to raise rates. The question is how quickly and how high they end up getting.
Yeah, and how to mix in the balance sheet and so on and so forth. And so, there's this discussion about, well, we can kind of use the balance sheet reduction, and that can maybe allow us to hike rates at a slower pace. I think it's very interesting to see, just how far the market is ahead of, what the core of the committee has said. Even some of the hawks on the committee saying, I'm still, around 3 rate hikes this year, which is what we saw on the dot plot. And, obviously it's evolving, but that kind of center of the committee hasn't really changed that much. There's still a lot that are saying 3 kind of rate hikes, and we'll start in March and go relatively slowly. And so the market is pricing in 6+ rate hikes this year. And
we should note that they're pricing in these rate hikes because, I don't know, 2 weeks ago, we got a blowout jobs report.
Yep.
We got a blowout jobs report and additional inflation prints that are frightening people. So it's not like, they got to be heading in this direction. Like they are responding to actual data they're seeing out there.
Oh yeah, that's true. I mean, the market is trying to get ahead of the Fed on this as it is wont to do. But the question is this? We've seen the way that financial markets are reacting. Is there going to be some sense of relief if they start in March with 25 basis points instead of 50? The markets have pushed the bar pretty high. And so one of the positive stories that you might be able to tell is, when March comes around and they do 25 or, do 50, but with, put some bubble wrap around the language and maybe it's not as hawkish. I personally think they're going to do 25 in March. And I think that might offer some sort of glimmer of relief that the Fed isn't just like hell bent for leather, tighten the screws until damn the torpedoes. Who cares what happens in the markets? I just don't think that the center of the committee is there.
Yeah, I think you're right on that. One thing I've been saying for a long time is, for a good while now, right, as we've gotten more readings on the economy, is that for as sour as people are right now, a lot of people comparing this to the 70s, and I think one thing is clear is that sentiment is down near what as though we were in a malaise, late 70s style economy. That is how sour people are on the outlook right now. It's that bad. But I keep saying the economics of it, this economy is not a malaise economy. We just got a blowout jobs report. We have great job creation. Anybody who wants a job can get a job right now. Interest rates are super low, very accommodative. We do have this inflation problem. That's clearly there, and that's an issue. But if the 3 legs of malaise are high interest rates, high unemployment, and high inflation, we've only got one of those legs. Now, if people are this sour about the world today, and now the Fed's going to start raising interest rates, and the Fed is going to stop buying mortgage-backed securities, and we start seeing, some impacts in housing markets and interest rates going up. And now we all know, we look at this and say, well, look, I mean, rates, inching up a little bit aren't a big deal, but on you may have 100% increase in what you're paying, right? You go from 1.5% to 2%.
The 30-year mortgage.
That's a big
30-year mortgage at 4% now, and we hit a low of 2.7 right about a year ago.
And that's
a big difference out of your pocket. I'm
going to take the froth off the top of the house.
And we're seeing that from the weekly Mortgage Bankers Association data. The last 2 weeks have been fairly negative, and across all 4 regions, in terms of new applications for single family housing.
Tony, I think
but also interesting that the New York Fed put out their inflation expectation survey this week, where they just quiz people, and across the board, everyone expects it to remain elevated in 2020. But for the 2 and 3 year, they expected to kind of go back where we were, 2 to 3%. So even though people are mad about inflation now, the average consumer expects it to be normalized in the next year.
Guys, I think though the one, and I don't know how unprecedented or precedented this is, but there are two stories to the two parts of the inflation story, because we're seeing consumer spending hold really firm and strong, and and a lot of that's because people are paying higher prices for goods, not because like the basket sizes are larger in the research vernacular. But there's really two ends of that spectrum. The consumer spending is being bolstered by people in middle to upper middle to higher income categories, because they're still living off all of the proceeds of like the financial boom that they experienced over the last 18 or 19 months and change. And it's the lower end of the income spectrum that's getting hit much harder by inflation at the grocery store and the pump. But basically, it's leveling itself out such that the people who are spending more are spending much more than the people who are spending less are spending less, if that makes sense, right? So there's I don't know how true that's always been about inflation, or I'm not a historian in that area, but that's absolutely what's happening right now.
Yeah, well, John Fagan, your note, you noted, you guys noted, Walmart report, which was pretty strong. Are there some tea leaves to read there?
So their prices, they were affected by higher input costs and especially in the supply chain, but they're doing a very good job of handling it, and they let it eat into margins. They didn't pass it on, but most importantly, their outlook for the rest of 2020 and 2023 was above what the street had been expecting. So they're pretty confident that they've seen the worst of what they've got. So the read-through from Walmart was kind of similar to some of the read-throughs from other big companies, like we talked about, like the payment networks are seeing, somewhat return to normalcy.
Should note that Walmart is an HPS client, but yeah, that was look. I mean, they run a terrific business, and they've done, and they are for the point of this show, a macro standpoint. You could do a lot worse than looking at how Walmart is doing to have a sense of how the American consumer is doing. They give you the fattest slice of it.
Yeah, they stole Mariel from us, though, so they're dead to me.
Yes, they did, including from the HPS podcast team.
And next week we've got Macy's, we've got Lowe's and Home Depot. Those are maybe not as consequential as Walmart, but still really interesting data points on the U.S. consumer.
Yeah, especially the home improvement. John, you've seen that, right, in some of your data.
Yeah, and you look, in Walmart, I mean, I think there's still this sort of mischaracterization of Walmart, or at least that has evolved a lot, that it was more kind of, it is, their customer base is the U.S. Census. It is not like middle class to lower middle class consumers, like this perception that like, one group goes to Target and one goes to Walmart. Like Walmart has diversified itself so incredibly well that its customer base is everybody, right? So they do capture the ups and the downs of both.
Yeah, and it's a grocery store too. It's
correct.
Not even just
it's the biggest grocery store. Yeah.
It'll be interesting to see like what some of the dollar stores report, or that might be a little bit better of an indicator of some things down the road too. Crazy times.
What should we be looking at toward for next week, guys?
It's a little quieter on the influential data front. We get the global PMIs, which will be interesting, especially because most of the world is now on the downside of the Omicron. So we'll see. We probably should be able to see, especially in the services PMIs, if activity has picked up. And then obviously we're going to be paying a lot of attention to the border of Ukraine and Russia. In terms of earnings, like John was saying, we get Home Depot, Macy's, and Lowe's.
Yeah, it's going to be really interesting to see what we see from them.
Yeah. And I also imagine we're going to get a lot more Fed speakers next week too.
Yeah. It's always great to see how they've done, but really I love to read into their earnings calls just as they talk about their outlook, sort of the going forward indications. That's always fascinating from the big retailers.
Yeah, just one more thing for next week. The Iran nuclear deal talks are going on.
Good point.
The commentary has been that the end of the month, this is a critical period. It's a critical week. We've seen, despite the ongoing tensions in Russia, Ukraine, which has fattened up the geostrategic risk premium in oil prices, we've seen them come off the highest levels over the last couple of days. And that's in no small part due to some better atmospherics around the negotiations. And OPEC is trying to get ahead of it, which is always if OPEC is trying to say, hey, if you guys get a deal, then we're going to put Iran into our supply curb framework, right? So they don't just unleash a torrent of Iranian oil onto global crude markets. So if OPEC is trying to get ahead of this, then there may be something to watch. Clearly, if you're the Biden administration and you are worried about prices at the pump and looking at what's going on there, your incentives may have already been high, but now they're even higher to get something done on this front. It's one of the very tangible things that you can do to help ameliorate that problem.
Yeah, that's a somewhat important deadline, but much more important is the MLB has said the 28th we need a deal by if the season's going to start on time. So we really got to start cracking on that.
No chance.
We need opening day.
No chance. I don't see it. I mean, there's expect the worst always with these guys. I should say though, the United States Congress though did manage to take one risk factor off the table by doing the absolute bare of funding the government for another 3 weeks.
3 weeks. Thank you very much.
Yeah, so they did pass an extension for through March 11th, and then promptly left town. So, way to go, guys! Quick
question, Tony, on Congress. Is Biden going to get all 5 Fed?
He will.
Appointees, you think so?
They'll all get through. I don't think these are anything more than delaying tactics. If they come to the floor, they'll get the votes, and if they come to the floor, if they can get them out of, they're going to force them out of committee eventually, and the votes are there for them once they get to the floor of the Senate. But it's frustrating for everyone to watch the Senate confirmation process. I mean, it's just not. This isn't the way the founders intended the process to work. So I guess we could say that about a lot of things. John Dick, thanks for joining us as always.
Always a blast.
Yep, guys. I will not be on the show next week. I'm going to El Salvador for the World Food Program next week, looking at some of our programs on the ground. The world's greatest disaster relief agency, amazing people and amazing work that they do. And I'm proud to be on the board of World Food Program USA. So we're going to be in country next week and get to see their work on the ground. But I will be back the following week, and looking forward to that. But have a great weekend and have a great week, guys.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.